My young apprentice walking cautiously at the edge of the financial abyss, you must understand one truth before all others. The reason financial celebrities appear fearless is not because they take reckless risks, but because they possess a mastery over risk that the ordinary investor cannot yet comprehend. To the inexperienced eye, their decisions look bold, daring, even dangerous. But beneath every courageous move lies a mental architecture of discipline, calculation, and philosophical clarity, built over decades of navigating storms that would shatter lesser souls. The greats, Buffett, Dalio, Soros, Musk, Icahn, Lynch, have learned that wealth is not created by avoiding risk, but by understanding it, shaping it, and bending it to one's advantage. And so, if you wish to walk the path of these giants, you must study not their profits but the invisible shields that protect them. Let us begin with Warren Buffett, who manages risk not by forecasting uncertainty, but by eliminating unnecessary vulnerability. To Buffett, risk is not volatility. It is the possibility of permanent capital loss. Thus, he avoids businesses he does not understand, industries without durable moats, management teams without integrity, and prices that do not offer margin of safety. His risk strategy is disarmingly simple, yet profoundly wise. Reduce the number of unknowns, and you reduce the number of ways the world can hurt you. He seeks businesses where probability favors him not occasionally, but relentlessly, day after day, year after year. He manages risk through patience, through restraint, through mastery of saying no. It is in refusing 95% of opportunities that he secures the remaining 5% with unwavering confidence. Now turn your gaze to Ray Dalio, master of macro storms. Dalio manages risk through diversification, not the shallow diversification preached to amateurs, but deep, structural diversification across asset classes, geographies, time horizons, and economic regimes. He understands that no human mind, no matter how brilliant, can predict the future consistently. Therefore, Dalio does not bet on certainty. He builds portfolios resilient to uncertainty. His all-weather strategy emerged from a fundamental truth. Risk must be spread across environments, not assets. Inflation, deflation, growth, recession, each demands allies and hedges. Dalio's risk management is a symphony of probabilities, a balancing act between humility and design. His greatest risk tool is not leverage nor analysis. It is radical open-mindedness, the ability to admit he could be wrong at any moment. Then observe George Soros, the alchemist of reflexivity, whose approach to risk differs from all others. Soros does not manage risk by avoiding large bets. He manages risk by listening to the whispers of doubt within himself. Soros says his back aches when his positions are wrong, not as superstition, but as acknowledgement that the body senses tension before the mind admits error. Soros manages risk by reversing quickly, ruthlessly, and without ego. To him, staying wrong is deadlier than being wrong. He scales into conviction and exits weakness instantly. His risk philosophy is rooted in flexibility. The market punishes rigidity, but rewards those who pivot the moment truth changes. Now consider Elon Musk, whose risk management appears reckless to the public, but is in fact grounded in first principles engineering rather than financial gambling. Musk does not separate risk from mission. He frames risk in terms of survival of vision. When Tesla or SpaceX approached collapse, Musk cut costs, doubled production, slept on factory floors, and redesigned processes from scratch. His risk strategy is intensity, compress time, solve problems at the root, remove waste, accelerate feedback loops. To Musk, risk is mitigated not through hedging but through learning speed. He reduces risk by attacking bottlenecks before they metastasize. Where financiers use models, Musk uses iteration. Where others diversify, he focuses. And while such extremity would destroy ordinary people, Musk's resilience makes him an outlier capable of surviving risk profiles impossible for the masses. Turn now to Peter Lynch, whose brilliance in risk management comes from staying close to reality rather than abstractions. Lynch mitigated risk by investing in businesses he could explain in a few sentences and by observing real-world trends, store traffic, customer behavior, product appeal. His risk edge came not from complex analysis, but from intimacy with the companies he owned. Lynch understood that the greatest risk in investing comes from not knowing what you truly own. By grounding his decisions in everyday life, he avoided the illusions of complicated narratives that have destroyed many brilliant minds. Let us not ignore Carl Icahn, whose career teaches that risk can be weaponized through control. While others fear volatility, Icahn embraces it because he creates catalysts rather than waiting for them. Risk diminishes when a man can influence outcomes. Icahn's activism shaping management decisions, restructuring debt, forcing operational changes, reduces uncertainty by replacing passive waiting with active intervention. His approach teaches you that sometimes the best risk management is not analysis but power. But my young student, risk is not merely a financial construct. It is a psychological one. Every financial celebrity has a unique temperament for handling it, and temperament, not intelligence, determines who survives long enough to become wealthy. The Titans share several psychological traits that protect them from self-destruction. First, they practice emotional neutrality. Masters do not panic in drawdowns, nor become euphoric in rallies. They view markets like a seasoned sailor, views waves, patterns, not threats. Second, they anchor decisions in principles. Dalio has principles. Buffett has the margin of safety. Soros has reflexivity. Musk has first principles reasoning. These principles act as shields when emotion attempts mutiny. Third, they understand that risk cannot be eliminated, only exchanged. Every investment trades one form of uncertainty for another. Amateurs seek safety in illusions. Masters choose uncertainties they can understand and influence. Fourth, they separate identity from outcome. A losing trade does not make them losers. A wrong decision does not make them stupid. Ego is the single greatest amplifier of risk. They minimize it. But perhaps the most powerful truth is this: financial celebrities manage risk by designing their lives to withstand disaster. Buffett lives far below his means. Dalio builds systems that survive even without him. Soros sizes his positions so losses never destroy the whole portfolio. Musk reinvests relentlessly, sometimes mortgaging his future to keep his companies alive, yet always with a clarity of mission to guide him. Risk management is not about avoiding storms. It is about building vessels worthy of surviving them. And now, my young apprentice, as this scroll approaches its midpoint, we must step deeper into the labyrinth, into portfolio architecture, psychological defense mechanisms, time horizon manipulation, asymmetrical bets, and the ways these titans turn uncertainty itself into a source of strength rather than fear. For the true master does not hide from unpredictability, but learns to harness it like the wind filling the sails of a great ship. And now, my young apprentice, let us continue our journey into the deeper chambers of how financial celebrities transform risk from a lurking enemy into a loyal servant. For once an investor understands that uncertainty is inevitable, the next evolution is to make uncertainty work for them. This is where the titans separate themselves from the merely competent. Their brilliance lies not in predicting the future, but in positioning themselves so that whatever the future brings, there exists an asymmetrical outcome in their favor. And so the first great mechanism they employ is the architecture of asymmetry, seeking opportunities where the downside is limited, but the upside is vast. Soros mastered this in currency markets, Buffett in distressed equities, Musk in moonshot ventures. The principle is eternal. You cannot eliminate risk, but you can choose risks where the potential reward dwarfs the possible loss. It is in the hunting of such lopsided opportunities that fortunes are born. Then comes the second mechanism, time horizon manipulation. Financial celebrities do not experience risk the way ordinary people do because they stretch time itself. While retail investors tremble during a 20% correction, Buffett views such drops as discounts. While markets panic over short-term uncertainty, Dalio studies long-term cycles measured in decades. While traders chase daily movements, Lynch focuses on business growth unfolding over years. Risk shrinks when time expands. The impatient are devoured by volatility. The patient digest volatility into profit. The Titans understand that the greatest risk is not volatility, but the inability to endure it. Next is the mechanism of redundancy and buffers. The wise never walk the cliff's edge without rope. Buffett's cash reserves, Dalio's balancing of asset classes, Musk's relentless pursuit of additional revenue streams, Soros's sizing discipline, these are not signs of fear, but of respect for uncertainty. They design their portfolios like ancient fortress walls. Even if the outer layer falls, the inner defenses hold. Redundancy turns catastrophe into inconvenience. Then we come to information filtration, a subtle but powerful risk tool. Titans do not drown in the noise that enslaves ordinary investors. They filter information through principles, models, and mental frameworks, discarding 95% of what the world obsesses over. Musk ignores quarterly drama to focus on engineering constraints. Buffett filters out macro predictions entirely. Dalio filters through historical patterns. Soros filters through psychological pressures in markets. Risk grows when the mind is cluttered. Risk shrinks when the mind is disciplined. And now, my young apprentice, we arrive at one of the most potent mechanisms: position sizing and controlled exposure. Even the smartest idea becomes lethal when oversized. Soros made billions not just by being right, but by scaling his conviction at the right moment. Dalio distributes weight across environments. Buffett concentrates only when certainty is overwhelming. Icahn steps in with force only when he can influence outcomes. Risk is not in the asset, risk is in the size. It is not the snake that kills, it is how close you place your hand. Another mechanism emerges through the mastery of liquidity management. The Titans understand that a brilliant investment can still destroy you if you lack liquidity during crisis. Cash is not dead weight. Cash is optionality. It allows movement when others are frozen. It lets the investor choose action rather than be forced into liquidation. The untrained see cash as a drag. The master sees it as armor. Then consider the psychological insulation these giants build around themselves. Fear, greed, ego, impatience. These are the real sources of catastrophic risk. Buffett cultivates calm detachment. Dalio cultivates humility. Soros cultivates flexibility. Musk cultivates resilience. Lynch cultivates simplicity. These psychological structures are not personality traits, but intentional constructions. The greats do not merely survive risk, they survive themselves. Now, let us go deeper still, into the most esoteric yet powerful principle, the conversion of risk into feedback. Amateurs run from discomfort. Masters study it. When a trade moves against Soros, he investigates why before deciding whether to exit. When production fails at Tesla, Musk turns failure into iteration material. When macro trends diverge from expectations, Dalio updates his models. When Buffett misallocates capital, he documents the error for future discipline. The apprentice sees loss as pain. The master sees loss as information. Risk becomes the compass rather than the storm. And then, my young student, there is the crown jewel of risk mastery. They design their lives to be anti-fragile, not merely resilient, not merely strong, anti-fragile, strengthened by shocks, sharpened by volatility, elevated through stress. Just as muscles grow when stressed, so do great investors grow when markets challenge them. They structure their holdings, principles, relationships, and internal philosophies so that disorder becomes fuel rather than fire. Now, as this scroll approaches its close, let us gather the lessons into a single truth. Risk is not something to fear. It is something to understand, respect, and harness. It is not the destroyer of wealth, but the maker of fortunes. What destroys the ordinary is what elevates the extraordinary. And those financial celebrities who appear invincible are not protected by luck. They are protected by preparation, discipline, and a lifelong devotion to learning from uncertainty. So now, my apprentice of rising ambition, let me invite you to step forward in your own journey. Share in the comments which risk principle resonates most with your spirit. Which Titan's philosophy feels closest to your nature? And if this scroll has illuminated even one corner of the labyrinth for you, subscribe to this channel, where each lesson becomes another piece of armor for your financial destiny.